Welcome back to another episode. Today we're going to take a quick look at Meta Platforms, aka Facebook, and take a quick look at what I believe is probably one of the biggest bearish sentiment going around with this company, and that's how much money it's going to spend in the metaverse. Is it worth it for Facebook? Let's find out. If this is your first time here, make sure to hit the thumbs up, make sure to hit the subscribe button, check out the pinned comment where I have free Discord, free newsletter, and a lot of great investing links, so check that out. So Meta Platforms right now, pre-market, the stock is sitting at about $324, and pre-market doesn't seem to be any better. Right now we're kind of seeing this heavy kind of decline in growth stocks and even tech stocks, and let me just hit that for a bit. Remember, we're investing in companies, we're investing in the long term of things. Sometimes short-term volatility can seem very scary, but if we invest in companies we believe in the next 3 to 4 or 5 years will be a bigger company than they are now, then days like today we shouldn't worry. I'm pretty sure everybody has taken some form of hit. I know I have, and by no means am I worried because I believe in the companies that I have invested. Maybe in the short term of things may look scary, but in the long term of things, I believe I'm still gonna end up with amazing results. But now let's just jump back into Meta Platforms. So right now, Meta Platforms, from its all-time highs, the stock is down about 15.18%. So it's kind of seen quite a pullback right now. And like I mentioned, what is happening? What is the problem with Meta Platform? Meta Platform is increasing its expense for 2022 to focus on the metaverse. But by how much? And this is why I kind of created this cool presentation here. First, I wanted to take a quick look at the financials. See, where is Facebook right now? Where do they stand financially? And they stand in a very high place. No debt to their name. If we take a look at trailing 12 months revenue, it's about $112 billion. That's insane. Now, if we take a look at their trailing 12 months net income, it's about $40.3 billion. Trailing 12 months free cash flow, about 35.9. I think operating cash flow, trailing 12 months is over 50 billion. So we can see huge money maker, and they have a nice amount of cash right now. Cash and cash equivalents is about $58 billion with no debt to their name, like I mentioned. So financially, this is a company that I believe can try the risk, and we're going to take a quick look at my thoughts in a bit. But let's see how much money they're expecting to spend. So for the current forecast for 2021, their total expenses will be somewhere about 70 to 71 billion for this year. Now for the next year of 2022, they expect somewhere between 91 to 97 billion dollars to be on total expense. That's an extra 20 billion dollars. That's a lot of money. But when we take a quick look at everything else, yes, it might suck, but the company can do it. And if it's a mistake, I don't think it would be the worst thing. But overall, they're kind of showing that this expense is going to be driven by investments in technical and product talent and infrastructure related costs. And I'll explain a little bit more about that in a bit. But then they also say CapEx expending. So capital expense for 2021 it's expected to be 19 to 21 billion dollars. For 2022, they expect about 29 to 34 billion dollars. So around an extra 10 billion dollars there. They say that this is going to be driven by investments in data centers, servers, networks, infrastructures, and office facilities. But before we begin, let's take a listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the stock advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. And so now it seems like they're trying to spend a nice over 20 to 30 billion extra dollars in 2022. So now let me just share my overall thoughts, right? First, what do I want to say? The company financially can do this. We took a quick look at their financials. They will be able to to do this. And for me, it's that risk to reward ratio. What is the risk? The risk is, okay, maybe 1 year of spending a little bit more money. What is the reward? If this kind of product into the metaverse and kind of these, and it's not just the metaverse, right? We're going to see the other products that they're hitting. But if these products do well, then they can be a game changer for the company. And what am I risking as an investor? A year of maybe not that well of financial numbers. And this is what I believe is the biggest difference is, as an investor, do you want them to do this, right? Maybe some investors might not want it. They just want them to stay stable in the market that they're in. And that's it. They don't want them to innovate too much outside of their market. I personally, like I said, say yes. Even if it fails, it won't kill the company and the rewards could be amazing. Some other things to kind of keep in note of. First, when we take a quick look at total expenses, what do we see here? Total expenses is driven by investments in technical and product talents. Most of this is going to be new engineers that they're hiring. And the great thing about total expense might not be a great thing. It doesn't always have to be all cash expense. Sometimes it could be cash expense. Sometimes it could be stock expenses. And where are they spending this money? And this is what I wanted to show you guys. First, I take a quick look at LinkedIn here. Meta Platforms Worldwide right now is hiring a lot of engineers. We can see data center operations engineer, electrical engineers, production engineers, electrical engineers for Facebook Reality, software engineers, research engineers for audio technology, product development. Robot validation engineers, electrical engineer for power, for discovery production, documentations. So the amount of engineers that they're hiring is insane. Me as an investor, that excites me because I believe engineers, and I might be a little bit biased here from my prior career experience, engineers are what create the new products and are what are creating the next technology. And for them to be hiring this many engineers, I am excited to see where Facebook will be in the next 2 to 3 years. I mean, if you go to one of my favorite websites about Facebook, is their tech.facebook.com, where they show all the different markets that they're hitting in kind of this engineering world: artificial intelligence, reality labs, engineering, and gaming. Here, for example, they talk about how they're making haptic gloves. Who are the people designing these? The engineers that they're hiring. They're also kind of using artificial intelligence engineers to kind of develop more products for their social platforms. Here you have a product where a child can draw an image, and they use artificial intelligence to kind of get that image to kind of move around in a phone or something. So it kind of brings a positive experience to children using Facebook's platform. Then they're also working in augmented reality and virtual reality. Obviously, we've seen the Oculus platform, but here we can see a family kind of doing a video call, and people are using augmented reality to make this a more immersive or happier experience. And this is what I like to see, and I believe this is all due to the engineering talents that they're hiring. Now we can take a quick look at CapEx. CapEx is about an extra $12 billion right around. And obviously this will hurt free cash flow, because free cash flow, you kind of do your cash flow from operations minus CapEx, but it will not hurt too much of net income, right? One thing to remember is CapEx, when you buy, let's say, a data server, that data server might have a lifespan of 10, 15 years, however long. So even though they might spend X amount this year on that data center, the expenses actually in the income statement are kind of distributed within those 5 years. So it's not that kind of CapEx expense doesn't hit net income too much. You're not going to see that 12 billion being hit in net income right off the bat. And the other thing I want to mention is CapEx the CapEx is driven by investments in data centers, servers, network infrastructures, and office facilities. And this is stuff needed because Facebook right now is becoming such a huge beast. They're focusing on their social platforms. Within their social platforms, they're adding so many new kind of categories in it. They're adding, for example, in Instagram, right? They're adding the Reels, a lot of video stuff they're adding. In Facebook, they're adding that. They're kind of increasing that Facebook gaming and the Facebook streaming. And all these platforms need to have high data servers to kind of compute all this information and make it not as laggy on our end. So these kind of CapEx items that they're going to be spending on, or capital expenses that they're going to be buying, are needed for this company to make sure that they are on top and they provide the best solutions for their customers. So again, for me, this is probably a great move. I can definitely understand why some investors, especially if you're more like a value investor to some extent, that you want Facebook to kind of stay within that level of, hey, don't focus too much money in there. But like I mentioned, for me as an investor, if it's pretty much like a blank year for Facebook, right? Pretty much, let's say it's a blank year where they barely make any money, but that's not going to be the case. But let's just say that's the scenario. I, as an investor, would be happy because they took that risk. It's a risk that wouldn't destroy the company, because next year, as long as if they decide to kind of end it, things can go back to normal and they can kind of be that money making machine again. And finally, I just want to show one more chart on Facebook, and that is this Y chart. We can see Alphabet and Facebook used to kind of trend amongst each other. They used to trade amongst each other. Now they kind of diverted, right? There's a divergence happening here. Meta platform looks a little bit cheaper than Alphabet. Obviously, it could be investors just not excited about the future expenses for this company. But I do believe to some extent it might be creating some form of buying opportunity in the long term of things. So if things work out, I do believe this is going to be a great move for this company. I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.